Hola, Ignacio Perez Penes. I probably pronounced your surname so badly.
No
I'm going
worries.
to, but welcome. And this is the first time, obviously, you've been involved in this project. So you're a partner at Capital Strategies in Spain. And also, I'm going to maybe ask you about Latin America, because I believe you're quite active there. But for now, if we just quickly cover Spain, same question. What are the most dominant channels in Spain, and what does your business focus on?
Yes, thank you so much, Nigel. Spain is a bit different from other regions like UK, Netherlands, or even Latin America, where we don't have a pure institutional market. Okay, the institutions, the independent pension funds, are mostly embedded and driven and managed by the banks. Spain is a very bancarized system where there is only 4 to 7 pure independent pension funds. Okay, so it's not the most dominant channel that we do have nowadays in Spain. Going down, we have a dominant wholesale market with fund of funds, DPM, and insurance companies that are mostly driven through quantitative processes. And this is, we're talking about 280 billion euros nowadays. So it's one of the largest in Southern Europe. And going down, we have a very interesting retail network distribution that we go through the independent financial advisors and bankerized agents that we have in Spain, more than 6,000 agents. And this is quite important for a TPM business where you need to have resources, firstly, and a good service, because it can generate internal demand and will help TPMs like ourselves to put in place new ideas and new products from a bottom-up way.
And do you cover all these different channels within your business?
We do, yes. We have in Madrid. We have a staff of 15 persons here in Madrid, mostly of them dedicated to RM and sales. So we cover pretty much most of them. Yeah.
Great, thank you. And turning to regulation, I know your business is regulated like everyone else on this call. It's pretty tough, I believe, in Spain. So what has your business done from a regulatory perspective?
Yeah, the CNMV is one of the toughest, I would say, regulators that we have within the EU, because it has some interpretations besides the typical MiFID II interpretations, okay? So going to our pure business, the CNMV interpretation of our business is that we put in touch an asset manager with an investor. That means that we are providing the RTO services, reception and transmission of orders. That means that providing such service, we need to have a fully regulated license. And we do have it via an agencia de valores. Therefore, we need to be accomplished with that regulation and have enough resources and externalized services to accomplish on that, okay? From our perspective, it's good because it allows us to provide our services overseas with a secure framework that it does within the EU. And in front of the managers, I do believe, managers and investors as well, I do believe that it gives pretty much comfort to conduct the business under the strictest possible regulatory oversight, okay? To give you an example, we all know all the agreements that we sign with the different managers, and one of the first things is if they ask in the agreements is that if we are accomplished with our local regulation, okay? So that's, I do believe it gives comfort to the asset managers, yes.
Okay, great. And what sort of investment strategies are popular in Spain at the moment?
At the moment, I would say that alternative liquid strategies, mostly in the merger arb, absolute return, some real estate is what people is looking for. Spain is a very conservative, so low volatility products within the fixed income arena and multi-asset is what is demanded. If you go down to the retail networks where they will need maybe less sophisticated products, equity products, active or truly active equity products will always be in the portfolios. It's true that in the last, driving these turmoils and curves in the market, in the last weeks, I would say, we have been seeing more demand from tier one institutions moving into IG credit, and we do believe that high yield will follow it afterwards with the current situation of the spreads in the credit market.
Great, thanks. Just final question. Obviously, in Spanish-speaking Latin America, you seem to be active. For those watching, just quickly on LATAM, what are the opportunities over there?
LATAM is a very attractive market, especially for mid to large size asset managers, because in most of these countries, and I'm talking about the Andean region, Chile, Colombia, and Peru, plus Brazil, okay, even though that is more Portuguese speaking side, and there is quite good opportunities in those markets. It has some local requirements because of the size of the asset manager and the size of the fund. So sometimes boutique or niche asset managers cannot accomplish. But there's plenty of institutions out there and willing to invest into UCITS funds. It's true that in Chile, Colombia, and Peru, it has been challenging times in the last years because of the pandemic. Bear in mind that Chile, Colombia, Peru has pure private pension systems, okay? And the decisions of the governors, it has been to allow these pensioners to withdraw money from their saving in pension funds, okay? So in the last 18 months, pension funds has been adapting their portfolios due to this effect on the withdrawals. I mean, the system in these three countries, it's around 300 billion, and it has been reduced around 25% of their assets under management. While in the other side, we have Brazil, that is starting to open up and starting to access non-domestic investments. And it's a large country that it has, as of today, interest rates that is one of the challenging, but we're talking over 1.5 trillion industry, which is increasing nowadays, and it's a very attractive place to be.
Okay, great, thank you. A quick question for the three of you as third-party marketers. It's saying, is it commonplace for third-party distributors to continue to claim a fee from any investors which may invest in a fund for up to 12 months after any agreement between a fund and a third-party marketing company has ended? Who would like to answer that?
That's a good question. If I may, I can start. Yes, I do believe it's important to get paid after termination of any agreement. I would say that 12 months, it's the least that you can have. And we don't need to see this as an opportunity for any TPM, but it takes a while to build all this business, and we all know, okay, the time frame to enter into big institutions is a lot. So by having an agreement terminated, we do believe, and replacing that asset manager or that asset class for another alternative, we do believe that it needs to be paid as long as the asset manager is keep on receiving the fees from the investor.
Got it, thank you. Someone's asked, with the turmoil in the markets, they sense TPMs are probably more in demand. What sort of capacity constraints might a TPM have when it comes to taking on even more managers?
I agree on what Cor said. I mean, it's a matter of avoiding conflict of interest, be aligned with the manager, and as long as you put more managers on board, you need to put more resources. And that's why in the last years, we've been increasing, especially in our case, the team is both in Italy, in Spain, and in other regions. It's a matter of resources because you need to have the attention of the client. Yeah.
Okay, I understand that TPMs get a share of management fees. What is the success fee, and is that the same as a performance fee? A hedge fund would charge a management fee of 2% and performance fee. Do TPMs share in both?
Nothing to add. Yes, the compensation scheme in the TPMs is based either on a fixed fee, which is the retainer, or either just based on success. Success means that if you raise money, you get paid. What? That percentage, either of the management fee or both management fee and performance fee. And I agree with Andreas that sometimes when you get performance fee, it will lower down the percentage out of the fixed management fee. Yeah.
Are sunset clauses still common?
Sunset clauses would be kind of cooling period clauses to prevent asset managers to terminate an agreement when there is something going on. Okay, so normally, yes, we tend to have some period of sunset clause, like 6 to 12 months, to disincentivize the asset managers to terminate maybe while you are entering into a big institution after a long time of work. Yeah.
Well, thank you very much for your time. Let's move on to our other key partners in the project. Jeremy, he is the Managing Director and Head of Continental Europe, UK and Ireland at RBC Investor and Treasury Services. So welcome, Jeremy.
Thank you, Nigel.
Presumably you're in Luxembourg at the moment?
Yeah, just back from London. Yeah, I'm based in Luxembourg, so RBC, we are an asset servicer. We have offices in Luxembourg, Ireland, UK, France, Switzerland, but also Malaysia. So we support our clients when it comes to distribution in this country. So we don't do active distribution, but I would qualify ourselves as a distribution enabler, helping asset manager to bring on investor into the fund.
Sure, and I believe you tend to focus on investment managers, and there are many watching this who look after maybe 200 million up to 550 billion. Would that be correct?
Yeah, so we target mid-size asset manager where we can differentiate by the level of service we can offer. We are very strong shareholder services transfer agent in Luxembourg. So we've just to give you some example, we are connected to 10,000 distributors, 5,000 LPs. We process 47 million transaction, subscription redemption or capital call over the past 12 months. And we have investors that are coming from 110 countries. So that's why, I use the word distribution enabler.
Okay, got it. And what sort of services do you offer, let's say, investment managers and TPMs?
So mainly if we stick to the distribution side, our role is to do the shareholder services component of it, opening a account, transaction processing, and then make it seamless. So having access to all these distributors and all these LPs help our client base connecting with new investor. We do also fund administration and custody, but less relevant for the conversation we're having today.
Okay, great. And obviously you operate in two major IFCs in Europe, Dublin and Luxembourg. So what are your thoughts on Luxembourg versus Dublin? It's only fair I ask you that.
So, first of all, I'm selling Dublin and Luxembourg. So, I don't think we should oppose the two jurisdiction. I think that I wouldn't repeat what Stuart said, but I think that's very true. In the two jurisdiction, you have, the right toolbox for some products. So sometimes, and we've seen that with Luxembourg. Luxembourg has been, for example, the big winner of the private asset. So with the right fund structure, and this has really blossomed and boomed. But UCITS brand, for example, recognized as well in Ireland as in Luxembourg. So you would see Irish UCITS and Irish Luxembourg fund being distributed everywhere in the world. I would just say that it's a question sometimes of culture. It's a question of having the right legal structure, depending on the product you want to sell and where you want to distribute. I still feel that, being two offshore jurisdiction recognized everywhere, again, it will really depend on your strategy and what type of product you would like to build. So that's mainly the decision factor for doing something in Ireland or Luxembourg.
I'm pleased to say more questions coming through, which I'll come to in a minute. But final question for you, Jeremy, what do you consider to be the main distribution trends in continental Europe?
So what we see is, private asset is growing, that's for sure. So this is becoming bigger and bigger. I think that what we see is now retailization of the distribution of these private asset funds. So definitively that's a trend, having more of the retail as per the MiFID II classification of investor investing into a private asset fund where they had no access in the past. So I think that this is really booming, starting this day and will be booming over the next 3 years.
Great. Well, I really appreciate your insights and patience. Thank you. Stuart is founder and group CEO of GemCap. So welcome, Stuart. Let's quickly talk about GemCap. It's obviously a ManCo. For those of you who are watching who don't necessarily know what a ManCo is, could you just describe what the benefits of a ManCo are to, let's say, an investment management company?
Well, just very quickly on that, Nigel, we're a fund platform as well as a ManCo. So you have to have the two together. So we have a funds platform, which where all the funds sit. And then you have the management company, which does the oversight and helps manage those assets. In short, and in essence, what a ManCo is actually, we make life easy for investment managers. That's ultimately what we have to do to ensure that the whole infrastructure runs smoothly, in particular from a regulatory and an oversight point of view. And if you think about where this came from, when we first set up back in 2011, we were a self-managed investment company. So we were just a platform. And the regulator had made it pretty clear to a lot of platforms that they weren't happy with what had come out of the financial crisis. There's a lot of issues around the management of the funds by certain managers. And so they were asking for enhanced oversight of those platforms and the underlying funds. And so ManCo started to come, management companies started to come to the fore, to the point now that they dominate the market, and there's very few just self-managed investment corporations left in the marketplace. And what ManCo does, it provides oversight of various parties, such as the oversight of the investment manager, fund distribution, the administrator, financial aspects, as well as making sure that we give confidence to the investment manager and obviously to the regulator that we know that what's happening is being done properly. And it helps also the investment manager to negotiate some of the complex regulatory regimes that are underway and make sure they're done properly. And ultimately, I guess the part of this is that we provide substance, which is necessary to help raise the capital that they're looking for across Europe and also globally. So it allows the fund manager to focus on what they do best.
And obviously your business is clearly based in Dublin, regulated there as well. So what's the appeal of, let's say, the Republic of Ireland? You know I'm going to ask this, over other jurisdictions like, let's say, Luxembourg.
I'm not going to have a go at Luxembourg, because I know Jeremy at RBC they've got a very strong Luxembourg business there. I've been involved in the Irish funds business now for probably 20 odd years. I've sat a number of boards over there, and I found that the Irish funds business, they do have a very sort of can-do attitude. Even the regulator, which is it's very rare to say these days, is actually proactive as far as ensuring the funds industry grows. It's a globally recognised area. Irish funds are sold literally in every jurisdiction across the planet. It's English speaking. It's a common law. Certainly from a UK perspective, we recognise that, which is certainly different from Luxembourg, which is obviously a more of a mainstream European law jurisdiction. And it has a very strong financial services industry, and there's also a lot of companies there from multinational technology companies. So they're establishing themselves in Dublin, which means that, and it's something we can probably take to another seminar, another webinar, the whole investment in the workings of the funds industry takes technology, and the growth of fintech is massive in Dublin. So we're benefiting from that. So the point that we're trying to get a straight through processing, and the digitalization of our business is benefiting from this development in Dublin.
Okay, thank you. And from a ManCo perspective, what's the benefit of working with a TPM?
Well, if I may, I'd like to talk about the benefits of the investment manager as well as the TPM, if that's okay. Let me deal with the investment manager, which I guess goes back to the role of the ManCo. Every fund manager based in UK, Asia, US is trying to come into the European space. They want to grow their business without having to commit significant capital. And I mean capital in both financial, but also in human costs. So I think it's in order to run their business, and we work now with some managers who historically had their own businesses over here in Dublin, and they've just gone, you know, this is costing us too much time and money. So that means that they can give up a lot of that and hand that over to businesses like ourselves. There's less regulatory and compliance commitments, less risk and lower costs generally. I mean, one of our managers, we saved them €1 million on the day that they moved their assets to us, just in legal fees. So there are some massive benefits. And it allows the fund managers to focus very much on their core competencies. Administration is not an added value for a fund manager. Fund managers should stick to what they do best, which is run money. And having a Manco allows them to just focus on that, and actually having the benefits of then linking a Manco like Gencap to the third parties. And I'm glad to say that we work with all the third-party marketers on the call today, and we've got great working relationships with them, as well as a number of other managers, a number of other TPMs. And the beauty about the TPM market is that they're specialists. They know their market very well. I often say they don't know it, they shouldn't be in the game. You know, it's like a sales guy doesn't know how to sell. These guys really know their business. It's a known cost base, so you know what you're working with. You're not driven by having to grow the business and suddenly have all lots of infrastructure around the distribution. It's there. It's a plug and play model which works really, really well. And it gives you access to quite sophisticated capital markets, which otherwise you may not know. If you're sitting in New York, how do you know what's going on in Milan or Frankfurt? It's impossible. So it's really, really important for you to engage with the TPMs so you get access to those markets, which may be less familiar to you otherwise.
Sure, no, good point. And obviously you're working with lots of different TPMs and investment management companies. So what aspects of cross-border distribution should investment managers, for example, be made aware of?
Well, I think this is going to be picked up by everybody here on the call today because it's relevant to everybody. Obviously, every market is different. I mean, we always smile with our US managers who look at Europe and think it's one country, and we go, hang on, no, there's one less than there was 5 years ago, but it's still a significant market, and everyone has a different requirement. You got to register different markets, and we advise managers not to register in every market. Focus on Spain, focus on Germany, focus on the Nordics, wherever it may be, but have a focus. But that means in some cases you can't do cross-border. You've got to be very careful who you work with to make sure you can do cross-border. So if you're a UK manager, you've got to make sure you've got a regulated business over in Europe who can help sell you that product. That's really important. The other thing to bear in mind is translations. Now, I think my colleagues here on the call will know better about this, but we've got like 150 different kids, and about a third of those got different translations on them. So there's a lot of costs associated with it. So just make sure you've got to bear those in mind. And then the UK MiFID, from a UK point of view, MiFID, you can't fly in and fly out anymore. So just be aware of that. Don't think you just nip across and go and visit Paris and happen to bump into half a dozen managers, wealth managers. You're not allowed to do it anymore.
Great, thank you. Just